Welcome to Real Estate 360 Live with Ryan Sloper, the trusted name in real estate radio. Now, here's Ryan Sloper.
Welcome back, everybody, to another episode of Real Estate 360 Live. I'm your host, Ryan Sloper. For those of you not familiar with the podcast, my guest and I will cover all angles of real estate, from interest rates to the economy to what's happening in Washington and the Federal Reserve. Obviously, we cover a lot here. It is more, economics driven. We're going to give you the big picture behind what's taking place in the real estate markets, the interest rate markets, and the global economy. Those, a lot of people just write out or ask questions right to me and say that they have a hard time understanding, how a lot of this stuff plays into the day-to-day workings of mortgages and real estate. But at the end of the day, it has everything to do with everything. Each and every week we just dive deep pretty much into the Federal Reserve and how it's, they control everything. They control all the cards, interest rates, the economy, the stock market. It is all driven by that machine. We actually have Yellen, who's set to testify before Congress, Janet Yellen, Tuesday and Wednesday of this week. So we'll dive in today kind of a little bit further into what her potential remarks are going to be and what the implications of that could be. We've seen interest rates start to make a move slightly back up, stock market rising higher once again on really nothing. I mean, there's really no solid data out there that would really, give us a reason to believe that the stock market should continue higher, but yet it continues, and people will continue to be out there touting that, see, you're getting in, you didn't want to get in now, or get in, 2 weeks ago. You should get in now. Eventually, somebody's going to get caught holding the bag, and hopefully it's not too many people and their retirement accounts that are going to be at stake there. But joining me on our panel, as he does each and every week, is Louis Camarosano. Louis is a former school teacher, former attorney, and a former general manager of a major real estate portal. He's been cited in the media as a real estate industry expert, Wall Street Journal, Forbes, Fox Business, U.S. News, MSN, and numerous others. Louis, how are you doing today?
I'm doing splendid, Ryan. How are you? I'm
doing well, sir. I'm imagining you're up north, so as we talked before we came on, the snow obviously seems to be the prevailing theme across the media these days. Lots of snow in the north. Actually, I'm down here in Northern Virginia. We actually got some this weekend as well. So we would expect, right, that probably when some of these numbers start to come out and they're not so great, that we could start blaming things on the snow again.
Oh, absolutely. Yeah, last year you had the polar vortex. This year it'll be called the perfect storm. It has nothing to do with an economic slowdown globally or in the United States. It all has to do with the weather.
Yeah, you and I talk about this all the time. It's just, they try to find anything to latch on to. The headlines, they seem to get more and more desperate every day. You had sent me one last week. It was, U.S. housing starts fall, but still at lofty levels. And who's the one that gets to determine what lofty is,
lofty. Right? We've talked about new home sales, new home starts being at 30 and 40-year lows. They're lofty when you compare them to 2009, but they're still far below 2007, 654. I had a Twitter kind of interaction with a MarketWatch reporter, and he says, yes, but they're so much higher than they were in 2009. And when I sent him a chart showing back the last 10 years, he says, well, 2005, well, that was a bubble. I said, all right, well, let's go back even further. And as you go back further, you see that today's housing starts and today's new home sales are at levels last seen in 2009 at the height, at the depth of the Great Recession, but also at levels in the 70s and the 60s when there was 35-40% less population. So this lofty level thing is pure propaganda. It's designed because what they say is anytime there's bad economic data, they dismiss it away and they say still consistent with a recovery trend. They do it with the employment, saying that anytime there's dropping unemployment claims, that it's evidence of the of the improving and strengthening labor market. They never want to say anything bad about the economy, and they never report what the whole economy is, Ryan. This is what I figured out. we talked about it was real estate and the stock market, right? Those are the two things they pin their hat on. Well, the real estate market never really picked up to the point where they can claim recovery. So they focused on rising home prices, even though every other metric in real estate was down. Then when home prices stopped rising, they just started inventing that there is this lofty level of home building, lofty level of consumer demand for housing. Here comes Gen Z, here comes Gen Y. They're forming households, just making up stuff to make it look like there's still a housing recovery when there isn't. So you do have stock market gains. That's the only thing they can actually say they have. So they're jealously protecting that. The real estate market doesn't exist. And they stopped talking about it, but now they're talking about it as if it does exist and things are at lofty levels. And the other little fake thing that they like to point to, the only economic data that the top line number actually looks good are the job numbers. So they harp on that constantly. They ignore, if there's 10 economic reports and one of them happens to be a job report, 9 of them are bad, they miss expectations, but the job report comes in better than expected, even though it's part-time jobs, even though there's no wage growth, absent increases in minimum wage, and that's what they focus on, and that's what the story is, and that's what they talk about, enduring strength of the job market, robust job growth, and all the other nonsense propaganda that they use to try to claim that there's this economic recovery. And what happened, Ryan, with the Fed, the FOMC minutes, all the things that they talked about, all the concerns that they now have, they were all on the table when they started yakking about raising rates. None of these are new things. These are things that you talked about. The things that the Fed is now concerned about, why they might not be able to raise rates, were all the reasons that we've been talking about for the last 6 months and a year, why they won't be able to raise rates. They are not a surprise. Your favorite is global uncertainty. Okay, they talked about that. They're now worried about the dollar. The dollar has been getting strong since they really started accelerating their propaganda they were going to raise rates. So it's not a new concern. It's always been there. Now they're saying the labor market may not be as strong as it seems. We've been saying that all along. We know that the labor market numbers are from the Bureau of Lying Statistics, that they just make them up or they misinterpret them. They count jobs and not people. So if somebody has 2 jobs, there's 3 jobs, it looks like the labor market is improving when it's not. They're worried about the stock market. They're worried about not enough inflation. None of these things were unexpected. None of them weren't on the radar when they started talking about how everything was great and it's just a little matter of time until they raise rates. And now they're saying, well, we have to be patient. We're going to hear that tomorrow. She's going to raise the whole litany of concerns while still saying the economy is robust and solid. And still, she'll try to give that indication that, well, maybe we might raise rates, maybe we won't. I'm not going to talk about patient, but there are some concerns. And the whole farce will continue, and the stock market will rally.
Yeah, it's, week in and week out we talk about this, and we always talk about how the Fed, they don't ever truly acknowledge anything. They just talk about this, we have to investigate further. We don't have enough intel right now.
More data.
We're going to have more data to come out, and, this has been going on for 5+ years now, guys. I would think that you have enough data to show that what you're doing does not work. What you're doing creates artificial markets. What you're doing creates bubbles. What you're doing is going to create a catastrophe. Instead of letting things collapse, they'll start to point fingers that it's Congress's fault, that, now it's internet, it's, the global crisis that are unfolding. We have to pay attention to oil prices going lower. That's now coming into play. Well, they
but by the way, Ryan, I missed that one with the oil prices.
Right.
They said initially, and all along, all the media talking heads, that this was a great thing for the economy. This is wonderful. It's like a tax cut. And in the minutes they start saying, well, maybe there's a dark side too. Like we've been saying, that it's not all good news. That maybe it indicates a drop in demand. Maybe there might be knock-on effects with people losing their jobs in the shale oil industry. They didn't mention the derivatives blow up in the shale oil industry, but I'm sure they're thinking about that too. But they knew about this. They chose to ignore it as not one of their factors in presenting the rosy scenario. And then once the rosy scenario got too rosy, where people said, okay, well, go ahead and raise rates, they bring back all the things that they should have been talking about when they first started talking about raising rates that might bring the economy down.
Well, the interesting thing is we talk about this all the time. The stock market, basically, they make every move based upon what the Fed does and says, right?
You can't go on earnings and you can't go on revenue because they're not there.
Right, because they're not there. There's no wage growth. There's not anything. I mean, we don't have anything really solid. I mean, we have this. It's almost like a fantasy world that everybody lives in. And as long as things are going up, it's okay, right?
Yep.
But as soon as S hits the fan, so to speak, everybody's going to be like, well, what happened? There weren't warning signs. How did all this? Oh, the warning signs have been here for some time now, guys. It's not like you're just all of a sudden going to miss it.
All you have to do, Ron, is they'll go back and look at all the Reuters and AP headlines and say, look at that. Robust job growth, strengthening labor market, projected to grow. So there were no warning signs if you read Reuters, AP, and Bloomberg.
Well, you just brought up a great point earlier in the show. Just when you talked about the new home sales and the graph, the real hardcore data that shows how terrible new home sales are, right? That's the numbers that they don't like to look at. What they like to pull out is one little part of the data that, like, permits have been above 1 million unit pace since July, as if it's acceptable. Like, or if that's actually an improving economy with that level. They don't talk about that. They talk about it.
They don't put it in context.
People. No, it's
if you have two
confusing.
midgets and one is taller than the other, you say one's a giant.
Well, in 1 million,
in comparison to the other, he is.
Right. 1 million sounds like a lot for many people, so they assume, it's above 1 million. Things have got to be good. But historically speaking, it's not good. And with the low interest rate levels that we have, we would expect it to be much higher. If there was the demand for housing, they would continue to build. And if there's not that demand, then what do? They start to pull back. Now, why is it scary to me is because now all of the low down payment, more, I would say, credit risks, the credit risks are basically going down every single day. So, like, if you was 700 credit scores, now it's going to 660. I wouldn't be surprised in another couple of months at 640. They're having to. We talked about this probably about a year ago, Louis. That at some point,
your prediction.
That they were going to have to loosen the underwriting guidelines and able to get people into homes, because what they were doing with the interest rates was not enough. Enough. Because
but Ryan, are you seeing it? I am not in my area because I'm active in the housing market looking. And I am seeing homes still sitting there. I don't care what they've done with interest rates or credit scores. They're undergoing price reductions and still sitting there.
Okay, so DC Metro is a little bit different. As of beginning of this month, February, I have seen a pretty large swing influx of buyers to the market, pretty substantial. I felt like, if you remember, I actually thought that this was going to be the case for this area.
Yes.
I did anticipate that there was going to be that bump coming into the spring market. It's actually started earlier than usual. Matter of fact, I had a bunch of phone calls this weekend for people who want to go out and show houses in the snow, which is interesting to me. What I'm finding is the homes that are, as I always tell you, turnkey and not much to do, those are moving relatively quick. They're getting full price offers, no closing costs. So I am seeing that shift. Now, things are still price range sensitive. But the closer into the D.C. market, where a lot of the jobs are, and even the surrounding Northern Virginia areas are picking up quite substantially. Now, will that hold? I think it'll hold through the spring. I think last year was kind of an indicator. Well, remember, once we got into the summer, everything kind of died back off. I think what happened was that people get to talk and they start watching all these headlines. They look at the interest rates. And interest rates were sliding down, real low, and everybody was like, I got to get in. And now they're starting to tick back up again. I think it's pushing people to make that decision. See, I think a lot of people were kind of indecisive. I'm not sure if we should move or we should stay. Now I think it's gotten to the point, if people are able to sell their current home and get out of it and able to take another property on the other side to buy another house, then they're doing that. Now, this area is, I think they get a lot more benefit out of buying right now, mainly because, I think the people around here feel like they're more safe as far as their job situation is concerned.
Clearly.
You know what I mean? And that I think if you look on the national spectrum, when we start looking at like New York and we start looking at DC Metro, we start looking at San Francisco and those metropolitan areas, I do believe that it's going to be pretty consistent, that the sales will be up. Prices will probably increase quite a bit. Heading into the summer, I'd expect it to tail back off. I am seeing actually a push for new homes a little bit more in my area, but that's actually because our inventory levels are a little bit lower than most.
Right.
You know what I mean? And so naturally that would increase sales on the new home sale side. Now, what do you think the media is going to do? They're going to start pulling out those metropolitan areas, and they're going to say that this is what's going on across the country. And, you know, I'll have to look at the data as we move forward. I can tell that the sentiment overall in D.C. Metro is definitely up. People are, especially for homes priced in the sweet spot of anywhere between, like, let's just call it $300,000 and $550,000. They are being multiple contracts. They're moving in the first 5 to 10 days. Their agents are starting to write remarks in the listing that we're presenting contracts on this day. When they start doing that, there has been like this kind of a frenzy, a buyer's frenzy that's been created. I don't know how long that can last because I feel like in the metro area it's mainly because there's not enough inventory still. Like we still haven't gotten enough inventory on the market for me to actually make an accurate, you know, determination. Is if it's actually that many buyers out there or there's just still not enough inventory. And now,
well, that's how they created the price squeeze was by keeping inventory off the market and then generating enough demand through gimmicks like low interest rates and now lower credit scores to get the demand to exceed the supply. And so that's what's happening in the D.C. Metro. And what they'll say, though, based on observations like yours, which are truthful in the Washington, D.C. Metro area, that there's not enough inventory, and that's what's holding back the housing recovery. That statement is only true in selected areas. In other areas in the country, there's plenty of inventory. It's just not selling because the demand isn't there, because the jobs aren't there. So it's really, like you say, they're going to use San Francisco, D.C. Metro, and New York as kind of the standard bearers of what's happening in the real estate market, and nothing could be further than the truth. San Francisco is in a bubble because of all the markets, because they have the stock market bubble in Silicon Valley and stock options. New York similarly has Wall Street, and of course Washington, D.C. benefits from the credit bubble because they have not been hit at all by government cutbacks because there really aren't any federal cutbacks. They're state cutbacks. So anywhere where you have government work or Wall Street work, you're doing well. Those are the three cities where government work and Wall Street and investments are doing the best. The rest of the country doesn't benefit from that kind of federal spending or Wall Street or Silicon Valley type. So those housing markets are going nowhere.
Well, you know, and there's another thing that we should factor in, which we talk about all the time, is the stock market. So I honestly feel like it's a lot easier for people to make decisions when they constantly are watching their retirement accounts go higher, when they're watching their stock accounts, if they have them, go higher. You're talking about Silicon Valley. Well, what do you think would happen if one day we wake up and the stock market loses value by 20%? It will change the dynamic instantly, overnight.
Absolutely. The whole recovery story is over at that point, and the housing market stops, and that's when the Fed has to talk about highly accommodative monetary policy again for desperate times and so on. And the only desperate time is that the stock market went down, which never reflected the economy anyway.
It never did, yeah. But you know what? It apparently, to the majority of the people, it's good enough for them. And if it's good enough for the Wall Street, good enough for the hedge funds, good enough for the banks, and it's good enough for them too, they're just going to ride along. They're just along for the ride until, you know, the wheels fall off. But, you know, to me, you know, I always keep coming back to I don't think anything bad's going to happen in Obama's time, right? You hear me say that over and over again, right? But this is it just the language that's used by the Fed, what's taking place in the stock market. I mean, it just is like they know that they can get away with it but for only so long, which is why they acknowledge key things, like you said. They didn't want to acknowledge oil prices before, but now they kind of throw that in there at the end. So if anything happens, they can always come back to, well, see, we were worried about that a little bit, just not enough for us to make a decision to change anything, right? labor market gains and reduction in labor slack they talk about. They need more proof. How much proof do you need? So if all of a sudden there's this one terrible report that comes out so bad that that's enough proof, they can then say, looks like we need to start printing money again, right? Or what happens? Stock market crashes by 30%. Oh, well, we weren't ready for that. Well,
right.
You created it. How are you not ready for it?
Exactly. But the real disaster in all this, Ryan, is you get it, I get it. People listen to the show, understand it. There's a very small minority of people who understand this whole thing is a farce. Most people aren't paying attention, or if they are paying attention, they believe what's shoveled at them without any analysis. So that's how they get away with it. The most important thing to Obama right now is he wants to be remembered as a modern-day FDR. So he wants is, and since he doesn't have 4 terms or 3 terms, or at least he hasn't indicated he's going to try to stay on. But the point is, he wants to be able to say his legacy is healthcare is going to be a hard one because there's been so many. It's going to be hard in the history record to kind of cover up all the mistakes. They just had the most recent one with 800,000 people got the wrong tax stuff, and then you had the whole rollout was a problem. But the one thing he probably wants to hang his hat on is he came in turmoil in 2008 and saved the country from the next Great Depression. Mm-hmm. And therefore he wants to show like Reagan did, and by 84 it was morning in America. He's trying to create the narrative for his historical record that by 2012 they had turned the corner, the economy was growing, there were more jobs created than ever in the last 70 years or something, and that it's all attributable to whatever his policy was to create this economic revival.
Yep.
And Reuters, AP, and Bloomberg are more than happy to go along with the narrative, how the enduring strength of the U.S. economy. And if anything goes wrong with that, like you say, he doesn't want anything to happen, and they're trying to make sure nothing happens before the next election that would make it obvious that the economy isn't doing well or collapse or stock market or whatever. That's their plan, is to make it look like from 2008 to 2016 he set the economic ship straight.
Absolutely, and if they just use where the stock market is, but when the time for the next election comes, if nothing changes between now and then,
they'll trot that chart out for history. The stock market was at 666 and the S&P, on this date, and now it's at 2,000.
Right, and setting records. Looks like proof the employment is on the rise. Look, the gas prices are lower. We're doing our job. But yet they don't, where it's actually counterproductive, and it's actually creating more.
Dollar is strong too.
Oh, dollar strong. We have a low interest rate environment. People are buying houses. We're easing guidelines for the government FHA loans to make it easier for people to buy. So
the second dawn in America. It's bigger than the Reagan recovery, and they did it without raising rates. They did it by lowering rates. Think about the exact opposite. The way they engineered the recovery in the early 80s was by raising rates and breaking the back of inflation. Now they're doing the exact opposite. They're saying that they are breaking the back of deflation by lowering rates, possibly going to negative rates. It's interesting, Ryan. Back in during that time period when there was massive inflation, that's when the scientists were talking about global cooling. Mm-hmm. And now that we're talking about deflation, we're talking about global warming. So maybe there's a correlation between the two. I don't know.
Could be. More or less, they just are different distractions, right? Like they just create these. I mean, there's always these other stories that we're talking about. Before you and I came on, you were talking about the Brian Williams and Bill O'Reilly stories, and how easy it is for everybody to just get sidetracked with the nonsense, right? And I think it is kind of maybe it is important that we bring this up because it proves the point of, why should you ever listen to anybody that's on TV? They're lying to you all the time. Like, why is this news to us? Why is it news? Just like the BLS comes out with their statistics. Why should we believe them? Right?
But that's not why these stories have come into the fore. Because they're not talking about why should you that may be the message you and I get. Why should you believe the official story and the interpretation that we get? But this is about why should you believe these people as individuals based on the inventions and fantasies that they invented about being in combat zones when they weren't. Because if they were really interested of blowing the whistle on lying in the media, they would talk about how they lie to present certain points of view that are favorable to their corporate backers or even the government. Mm-hmm. That's not what they're talking about. They're attacking Bill O'Reilly and Brian Williams as individuals for making up stories about their own personal life.
Yeah.
But what it does serve the purpose, Ryan, of distracting you. But it's not to serve the purpose to say, don't believe the media. They're saying, believe the media because we uncover this kind of stuff. We know, we'll weed out our liars.
Right, we'll take
Brian Williams, and we'll weed them out on the left and the right. We'll get that O'Reilly guy too because he's lying, and we'll get Brian Williams. We don't care whether they're liberals or conservatives, Republicans or Democrats. We're interested in truth in media, and we won't have these storytellers. Sure they will.
Well,
that's how they get their job.
Oh yeah, nobody would call anybody out on a business related story, right?
For example, you've seen the people who when you talk about Benghazi, wherever it is, that's when they're told to keep their mouth shut if they find something that's critical. Those are the stories, where the truth might come out, and you find that their editor or boss tells them, no, you're not allowed to say that.
Mm-hmm.
But go ahead and talk about how, you were shot down over Iraq or over Afghanistan or whatever. That's okay. And, we'll hold that against you in a few years if we decide we don't like what you're doing, and then we'll say you're a liar.
Right. I mean, it's, I tell you all the time, you can't help but to see this stuff either. Like, I told you that I don't really watch much TV, but when I do go to the internet, like, videos pop up and it's talking on social media, so it's in front of your face, and you'd be hard pressed to not come across some of this stuff. So, and part of, you and I doing this show, we do need to know what's going on out there, and I'm sure many people have heard of a lot of these stories. But, the interesting part is when you talk more about these personal stories, and when people they talk about, the movie The Sniper that came up and the controversy surrounding that. We don't have the same hype around, well, look what's taking place with the Federal Reserve and Congress. Look what they're doing to our country, right? There's not that hype that's built up because we have the media that misconstrues the facts and basically creates this vision of recovery and stability, and it's always improving, and look where the stock market is. So people are completely, I think, just misinformed and not asking better questions. One of the things I always tell people, I said, you want better answer, ask better questions, right?
Exactly.
Very
good point.
Don't just look at a report, an economic report, a business report, a story, any of it, and not do your due diligence. That's what we do on this show every week. Why is the Federal Reserve telling us these things? Well, the reason why is because they don't have a choice. They have to double talk. They're going to tell you something over here and then tell you something completely different at the end of that. Because if you
don't believe it, Ryan, look at the Swiss National Bank did. Maintaining the euro Swiss franc peg was essential to their policy. They would never abandon it. Then one morning they just said, guess what, we're not doing it anymore.
Right.
Okay, so it's the same with the Fed. They can go on and on about their policy and what they're going to do and how they're dedicated to it until they decide they're not dedicated to it.
Yeah, and so this is a question that I've got probably 50 different times lately, right, Lewis? Well, if everything you're saying is true, then so when is the stock market going to crash, right? And I can't give you that answer. All I can tell you is the underlying fundamentals of this economy are not where they should be to have a stock market at the levels that they're at. Right?
Well, the volumes are low, too. It's not like everyone's buying stocks and driving them up. Very low volume.
Exactly. Low volume, and who would probably be the ones that are trading, right? Maybe institutions, hedge funds. Now, guess what happens with the power that they have money-wise? They can really swing a market at the drop of a hat, right? We talked about Warren Buffett and him changing his position. If somebody leaked that story, okay, and actually they consider starting to short them. They might start to short the market all of a sudden because Warren Buffett says that. I would think otherwise. I would say, oh, he's probably starting to position, getting people's mind going one direction. He's not going to do it when everybody thinks they're going to, when they think they're going to do it. You know what I mean? He's going to do it when people least expect it. And the average Joe doesn't know the market that well. They don't have enough money for it to really be able to help them. And, you know, realistically, I 100% believe that the stock market is so far overbought at this point. It could go higher. Yes, it could. But all the people that have been making money for the last 4 or 5 years, the stock market riding up, don't think that whether it's next year, 2 years, 3 years from now, that in one swoop it couldn't just go back by 50% and they lose all their gains.
Mm-hmm.
Right? And I think that people forget that. You won't be able to pull your money out fast enough when it does happen because it will be a mad rush. Do you agree with that, Louis? I mean, I think this is the one side that nobody talks about because everybody.
It's the same with buying gold. You can buy it right now, and so you don't because it's cheap. But when those events happen, then you can't get it.
Mm-hmm.
You know, the time to buy insurance is before your house burns down, not when flames are coming out of the window. And it's the same with the stock market. The time to get out is when you're doing well. It's the John Kennedy quote, the time to fix the roof is when the sun is shining, not when it starts raining.
Right. And at this point, you know, it's like we talked about this a couple of weeks ago when you talked about, you know, baby boomers and seniors having to, you know, take their money that they were going to keep in maybe just a basic CD or savings account making some interest to live off of and actually take that money and invest it in the markets to actually live. I give you an example of my grandmother, and it was actually funny because I was having a conversation with my mom yesterday, and she said, you know, it's interesting because, like, I don't want what happened to my mom to happen to me. And I started thinking about it, and I was like, well, you know, it's funny because my grandmother and grandfather, they were savers their whole life, and they felt like that as long as they had a nest egg saved up and as long as they could make X amount of interest, they would be able to not have to deplete that account. They could have enough money from Social Security and from their retirement account to be able to live off that for the rest of their life. And I know that to not be the truth because now she's worried about losing all of her nest egg and not having enough of money to see her to the end, right? And I'm asking my mom, what do you think is going to be different about your situation? I said, inflation is inevitable. If you want to maintain your current living standards, you essentially are going to need to probably have to go get another job or create another business to actually have some cash flow. Because all of this money that's coming out from investable, you know, stock market accounts or retirement accounts, we don't know where that's going to be, Louis, right? We don't know where that's going to be yet tomorrow, next year, 10 years from now.
Well, not just that, you also don't know what the tax rate will be when you go to take it out. Because right now you're getting tax deferred, but they can take all those tax deferred gains away from you if they just raise the rate of income that they're going to charge you when you take it out.
And we also don't know what's going to happen with a lot of these retirement plans that are, you know, they kind of choose where your money goes. What happens if more money starts pouring into treasuries or mortgage-backed securities or whatever else it is that, you know, these plans, like let's just call it, you know, fidelities, they want to put your money in. Now, you do get a little bit of say in that, but most people I've kind of found from talking don't really know what their money's invested in. They couldn't tell you.
No, and worse, Ryan, what happens if the government decides what retirement plans to invest in?
Or
you got to have 50%, 60% treasury account, U.S. Treasuries. Not because they need the money or because no one else will buy them, but because they have deemed them safe for you. And they have every right to do that because they've given you all this tax advantage. It's not really your money. It's your money subject to the regulations that they put on it. You can only put a certain amount in. You can take only a certain amount out. You get penalized if you take it out before a certain age. You have to take a certain amount out when you get to a certain age. So it's not really your money like you just go and take it out whenever you want. So they can put whatever restrictions they want on it.
And it's not out of this world to think that they won't do that. I mean, just think, people years ago would have said, "There's no way we'll ever have a healthcare system like that."
Exactly.
That's not going to happen. Not here, not in the United States. That's not going to happen. And now that it's here, everybody's like, "Well, how'd they do that?" Well, don't think that they can't. They can't.
And we could just get rid of it. Sure, you can. Ask John Boehner how that goes.
Right. And
give them something to cry about.
Right, and don't think that if they don't need money, if the government doesn't start needing money, they will go after those retirement accounts. That's where the most amount of money is right now. And that will be the first
But so far,
they
haven't had to. You see, here's what the thing is. Because of the reserve currency and because the dollar is in demand, they have not had to tax people or raise their accounts. All they have to do, which they've done in other countries, all they have to do is print more money. And it's astounding that if they can keep the dollar strong, Ryan, they can continue to do that and keep the population happy in a sense that they're not taking their money and they're not raising their taxes. But what happens when there's less need for the dollar? If oil stays low, right? Countries have dollars because they need to buy oil. Well, they don't need to have dollars if oil is lower. They need fewer dollars. If all the debts are reneged on or forgiven or restructured, well, then they don't need dollars to pay them back. If fewer countries use the dollar, like Russia and China are doing by setting up these BRICS banks and SWIFT systems outside of the SWIFT system, trading in their own currencies, then you have a problem because the Fed still has this massive balance sheet. We still have not cut spending one bit. We're not in austerity or anything like that. What happens when demand for the dollar goes down? Like right now, everybody thinks that can't happen because the dollar is strong. But the dollar really isn't strong. If you look at the underlying obligations that the U.S. has made no effort to reduce those obligations. And those obligations not only include domestic spending, but include military spending that no other country has undertaken. And the United States spends 10 times more than anyone else in military. That all has to come from somewhere. And if there's no demand for the dollar, or not no demand. See, this dollar collapse talk is kind of nonsense. There just has to be a reduction in demand for dollars for there to be a problem. And I think that's inevitable because when you see countries actively trying not to use dollars, well, then that already represents a lack of demand. And if it starts to turn out that people just need less dollars, not for any geopolitical reason, just because oil prices are lower, they just won't have as many. And we saw China and Russia reduce their treasury holdings in December. Now, Russia, of course, is going to reduce them probably down to nothing to fund their trade deficit. Probably they only have 86 billion U.S. treasuries left, which is only 1 month's worth of QE of QE3. So that's not a big deal. China has like 1.4 billion. Japan has like a trillion. Both of them have over a trillion. If they start to drop there for whatever reason, and then other countries don't need to have dollars, they have enough to conduct the trade where they need to use dollars, but they start diversifying their portfolios, that's where the demand for the U.S., and that's where the Fed has to come back in and sop up that demand. They didn't have to do that at the end of QE3, as you and I had expected was going to be a problem. We thought once the Fed stopped buying treasuries, there was going to be a lack of demand. Well, that turned out not to be true. Somehow, there's still Fed intervention. They're doing currency swaps. They're rolling over principal that they bought. And other countries, Belgium, have stepped up and have bought U.S. treasuries. At some point, though, there's got to be a lack of demand.
Yeah.
Right, but at some point, Ryan, there has to be a limit to any to demand for anything, especially something that can be printed willy-nilly, like dollars. And also because the Fed, even if there was this massive demand for dollars, and it was market-driven, and it was real, the Fed wouldn't allow it to continue because that would be deflationary. And the Fed is not going to allow that. Their whole point is they have an inflation target of 2%. Well, if everybody wants dollars, then the price of everything is going to go really low for Americans because the dollar would be so strong.
Yeah. Well, and
the Fed won't do that. They won't allow that. They'll print they'll go negative interest rates. They'll print to counteract that strong dollar.
And they can do that at any time. And that's why it's interesting with, the remarks that they constantly make. And, Yellen is set to testify at Congress, tomorrow and Wednesday, I believe. And I guarantee you that the questions that they ask are not going to be really the deep questions that need to be asked. It'll be like, what is the labor, what the term labor slack, what exactly does that mean, right? And she'll be able to spin her answer and just beat around the bush, never directly answer anything. Tell them that
they don't ask about implications. What happens if this happens, and what would you do? They're not allowed to ask that question.
No. Yeah, like we'll just have to review the data when it comes in, and we'll make a decision from there. It could be, this
Ryan,
year.
you and I can do that job. All that job requires is obfuscation and hitting the print button when you're told to hit it.
And a great question would be, what happens if the dollar starts to weaken and people, it's no longer.
Or the reverse. What happens if the dollar goes up to over 100?
Yeah.
What do you do?
And that's how simple of a question is that? But it won't get asked.
Yeah.
It won't. Instead they'll ask
and if it was, they wouldn't answer it.
No, they wouldn't
would
answer
say,
it.
we don't comment on market speculation, yet they make projections left and right all the time when they feel like it. And they're always wrong.
Well, I think, the only thing that it seems that ever gets talked about is the interest rate situation, right? Like that's
it. Yep.
That's the only thing they ever want to talk about, and to me at this point, it's not even worth talking about. We did notice that the 10-year note has been moving up quite a bit. So I'm sure they'll probably ask a question on the 10-year and interest rates and things like that. But we've gone 5 years now, 5+ years now. 6 years now at this point, and there's not going to be anything that's going to change. The only thing that's going to change is that they change the name to the QE program. That's the
right.
Only
They're
thing
talking about raising rates. After 6 years, they've been when we always play a Bernanke clip where he was talking about when the time would be to stop QE, raise rates, and to unwind their balance sheet and sell all the garbage that they bought. They haven't even done one rate hike yet.
And they're not going to do one this year either. I can promise you that. And if they do,
but even if they do, it's for show, and then they won't do it anymore.
Just like the tapering was. The tapering was just for show. It wasn't because they could have kept doing that. It wouldn't have really mattered. I mean, they're just numbers. It doesn't really matter what the amounts are at this point. But it just sent a message to the market that, hey, look, we don't have to spend this medicine, right? We can start to pull ourselves off, even though nobody asked the question. Well, you're not unwinding what you already bought.
Right. Now it comes down to this, Ryan, and this is the real point that if in 2009 Bernanke came out and said we are going to do a QE program, it's going to be multi-year, multi-trillion, and during that time we will print $4 trillion. It'll be open-ended because that's what it ended up being. And we keep rates at zero, the dollar would have collapsed. So this is what they're doing to appear. The reason the dollar is strong now is because the Fed has looks like it's prudent, and they use it's the cleanest shirt in the dirty laundry pile. No, it's not. It is being stewarded by the most reckless central bank ever, and the most reckless fiscal policy ever. In the sense that on the fiscal policy side, there's an $18 trillion deficit. There's hundreds of trillions of dollars of unfunded liabilities. And on the monetary side, they've had zero interest rates. Yeah, they're not at negative like some other countries, but they also printed $4 trillion in 2 years, in 6 years, out of thin air. So how is that the most prudent central bank? It's not.
It's not.
But the dollar is given this status of being strong just because they took a temporary sobriety check. Seriously. I mean, it's not like, the United States over the last 5 years has cut its deficit, has sorted out its Social Security, its Medicare problems. No, they added on to it Obamacare, which is another cost, and they haven't sorted out their monetary policy. What are they going to do with their $4 trillion balance sheet?
They're not going to do anything.
And then they forget all about this. Like somehow, the dollar is strong because it's strong, but not because there's any underlying fundamentals. Yeah, when you look at the Russian ruble, okay, that may be a garbage currency, people may say, but they don't have the debt levels that we have, and they do have some gold reserves.
Right.
Suppose the United States has them too. But the thing is, they were able to raise rates to try to combat the ruble's decline to 16-18%. The United States couldn't even raise rates to 5%. if there was ever a decline.
You know, I get I chuckle out of this all the time, but I always think it's just like, you know, the United States here, they're like, debt? What's debt? Right? Like, nobody even really has a clue as to what it is. I mean, the everyday
it's like the wealth of the nation.
Well, yeah.
Look at all the stuff we bought.
Right. Average Joe knows what debt is. Debt is something that he has a hard time repaying, could force him into bankruptcy, right? It could be those things. There's so much of it that he doesn't have enough income left over to feed his kids. That's what happens when the average Joe has debt. But when, you know, our country has debt, their solution is to just pay no mind to it, just continue to print money. We'll worry about it in the future, 10, 20, 30, 40, 50, 60, 100 years from now.
And if the markets reward you for that, why wouldn't you?
But you know what? It starts at the top. We talked about this before, right? And if they can get away with it and they can get rewarded for it, then so can the stock market, so can the companies that don't make any money, right?
Yeah.
It trickles down.
That's the example of how you make money is by taking on debt and not making money.
Not making money, you know, giving the appearance that your company is you know, this massive beast that has the potential to do something in the future but never does, right?
Yep.
And we've seen that for some time now, and it's, you know, to me it stinks because, like, when I'm out here and I actually see these hardworking business owners, small business owners that are actually trying to grow and expand, and they can't because of the lack of capitalization, because you know, the Obamacare, because of all these things.
Who wants to lend money to a business owner at a small percentage rate when there's much more money to be made elsewhere?
I understand the dynamic, but it's still sad. You know?
Oh, yeah. No, but that's like, where it's come. That should be a great opportunity as a lending bank, if that's what your business is to lend money to companies and to be smart, prudent lenders and find the companies that you can create reliable and trusted partnerships with, because you know that you're going to get your money back, and you're also going to be helping build a company's business and the community. They're going to create jobs that are long-lasting, and they're going to provide goods and services that everybody wants. Instead, the money flows towards stuff that just gets a high market capitalization on Wall Street through Silicon Valley.
Yeah, and you know, the interesting thing is they have some statistic out there that it's something like in the next 10 years, about 30 to 50% of the Fortune 500 companies will be out of business. And
well, that's always true.
Well, but what's funny about it now is though that a lot of those Fortune 500 companies or these startup companies are like these technology companies that don't even
for that reason they're going to become obsolete because they don't make any money.
Right. I mean, now we have companies that are Fortune 500 companies that don't really turn any net profit, and are still considered to be the best in the world.
You shouldn't even be. I mean, if you're going to create these indexes, they shouldn't even be on those indexes. If the company doesn't make money, I don't care what they're going to do, what their turnover, revenue, whatever you call it is, what their growth is. If there's no profitable growth, it isn't growth. Because you can't grow for 10 years and not show a profit and say, well, one day. One day is already passed.
Yeah. Yeah, I mean, and, you know, the debts that these companies have, these startup companies have, and how they go back for, you know, the second round of funding and the third round of funding, they still haven't turned a dime, but yet, you know, the investors continue to push because it's all about...
Or it's equity, it's not even debt. But it's not even debt. A lot of times it's just people throwing money at it because they think if they put $100 in, it'll go to $500, and it does.
Right. And you know, that is just a whole other bubble that at some point will come to an end. And, you know, realistically, I think a lot of that starts to coming to an end as soon as the stock market starts to retract just a little bit.
When does that happen? See, no one knows when that's going to happen. Not everyone, but we know it's inevitable. And the issue you have is when you talk the way we do, every day that goes by that the whole scheme stays afloat, it looks like you have no credibility.
And the Ponzi scheme, right?
Yeah, but it looks like you don't know what you're talking about because you say the evidence is, it's just like if you say this plane is not going to fly much longer, or the boat isn't going to go much further because it's been hit, and it continues to float for hours. You continue to stay aloft for hours. They can say, well, you're just Chicken Little. You're like, no, you don't get it. The three of the engines are gone, or we're losing water. They just don't see it.
Yeah, well, if you remember, I always bring people back. I'm like, okay, so let's go back to the last real estate bust that we had when everybody was getting free loans. The 7-Eleven workers making $125,000. The price of homes were going up 15-20% every year over year. People were selling their brand new home without even moving into it to the next guy in line. And everybody said that was never going to end, and it did.
I was told by one of the guys I work with. He said to me, "Oh, what's going to happen? They're like 30-40% of the people are just going to be in foreclosure." And I said, "Yeah, why not?"
Of course.
He said it like that was like that's ridiculous. And I said, "Well, if they can't pay because the interest rates readjust, I'm saying this in 2006, 2007, then of course they won't be able to pay." And then what he said was, "The government won't allow that to happen," and that's exactly why they do it. Because they know implicitly that you can take risks and get away with it.
Yeah, and it is the nature of the beast. I mean, and people would then turn around, and even with all those houses being foreclosed on, the media's out there touting that the economy is recovering at the same time that the rate of foreclosures is going up, right? Because that's the way they'll spend it. It's never going to be bad, but having basically an unlimited printing press where you can just print money, that's why I think things can continue on for much longer than you and I anticipate, Lewis. And we always say that there's maybe this bigger thing, whether it be a war or some sort of catastrophic event that takes place that sends things spiraling out of control. But it can't happen.
Even wars, Ryan, they're on top of that too. They know where all the hot spots are. In fact, they may even gin them up. It's under control.
Well, oil is one of them. The derivative market is one of them. I promise you that they're working on this right now, which is exactly why they added that little bit into those minutes. And nobody's going to ask that question because that would be interesting. The trillions of derivatives in oil, how is that going to affect the overall economy when 6 months down the road, oil prices are still where they're at right now?
Right.
And nobody's going to answer that question. I can tell you it's not a good answer.
But it'll give them an excuse to take emergency action when no one anticipated the impact on the shale companies, the derivatives, and the employment situation. Other than that, everything was fine. But this situation, they knew about it. They've known about it. It'll only become a problem when it becomes a problem, and when it does, it'll be unexpected.
Of course. Yep.
And that's the shame of the whole thing is there's enough people out there analyzing and can understand where the issues are. Now, a lot of the things that you point out or anyone points out as potential trouble spots don't always come to fruition.
No.
But they exist, and to act as if they don't exist and then to use them as evidence of a problem that you hadn't seen when it was there for you to see months and months and months earlier is disingenuous.
Like another problem that I see is actually lowering the credit standards to give people mortgages to get them into houses when we actually don't have an underlying solid economy where wages are increasing and jobs are stable. We don't have that. So
right, from the macro level, we don't have it. From the micro level, there's a lot of people who are going to buy houses that, as you say, don't deserve to buy them, meaning that they don't have the wherewithal to pay back the loan.
And what I mean by that, guys, anybody that's listening to this show, don't take offense to it. What I mean is, Lewis, if you were going to loan your money in your bank account to me, and I had to review your credit profile, look at your job history, look at all that, and let's just say that I had a 580 credit score, and I want to get 96.5% financed of $200,000, and I want to get it from you. You're the lender, and I've got collections on my credit report, and I have a couple job gaps in the last 2 years. Are you going to give me your money?
No.
No. Oh,
and it's not a moral issue. I don't think it's that you don't deserve it. It's that you can't pay it back.
You can't pay it back. The risk associated with that loan is too great for you to extend that money to me. And what's happening is we're going right back to where we were before, where when houses weren't moving because of a low interest rate environment, finally it took about 2 years. They're 2 years slow to figure this out, that the only way to increase home ownership is to basically make it easier to get a house.
Yep.
Because the interest rates weren't enough. So now you got to make it easier. And now that that's happening, we will see a bump. Like I told you, I feel like we will see a bump in the overall sales because of that.
You'll see more home runs if you bring the fences in 200 feet. That doesn't mean the hitters are any better.
That's a great analogy, and I think that this year is the start of it, because I already told you about the stated income loans that are coming out, the no income, no assets. They're starting, and this will continue on. I wouldn't be surprised if we start to see a lot of the regulation that they put forth on these lenders.
They'll take that back, right?
Yeah, they're going to pull
They
it all
need
back.
Texas leaguers to be grand slams.
That's exactly what's taking place, and it'll be interesting. Well, like I said, I'm in this on a daily basis, so I'll definitely keep everybody informed how things move forward as we progress through the spring. So we will keep our eyes on, obviously, Yellen and her testimony over the next 2 days. I'm sure it's going to be laughable at best.
We should play some clips.
Yes, well, we'll get some of those queued up for next week's show. Louis, thanks for coming on. If you wouldn't mind, give our listeners your blog so they can check out.
Thank you, Ryan. It's smallgold.com, SMAULGLD. It's a real estate, economics, gold and silver blog. Please check it out, smallgold.com.
Thanks, guys. Thanks for tuning in. Please download, subscribe, share on iTunes. Also, you can stream it live at realestate360live.com. On the right-hand side, there's an Ask a Question button for any questions you have or future topics you'd like us to cover. Until next time, take care.